Welcome to our deep dive on adjustable rate mortgages versus fixed rate mortgages. In this video, we will explore how to maximize savings or minimize risk based on your home tenure and risk tolerance. We will walk through real numbers, a practical stress test, and tips if you are using builder financing. We will also include quizzes to test your understanding along the way. Let us begin by outlining what we will cover. Here is the roadmap for today. We will start with the big picture comparison between adjustable rate and fixed rate mortgages. Next, we will discuss where an ARM shines for short-term holders. Then we will move to the security of a fixed rate. After that, we will run a stress test to make sure you can handle worst-case payment scenarios. We will add insight for buyers using builder financing. We will also show worked examples, diagrams, and comparisons. Then we will test your knowledge with a brief quiz and end with key takeaways and next steps. Now, let's set the context. The core decision often hinges on a meaningful rate gap, such as a 3.8% ARM versus a 4.99% fixed-rate mortgage. That spread can save hundreds of dollars per month initially, which is compelling for short-term homeowners. However, the ARM introduces future interest rate risk when the fixed introductory period ends. The best choice depends primarily on your expected time in the property and your personal tolerance for payment volatility. With that framing in place, let's transition to the specific advantages of an ARM. Adjustable rate mortgages typically start with a lower introductory interest rate and payment compared to fixed rate mortgages. This structure allows you to save the most money during the first years of the loan, which is when interest accrues most heavily on an amortizing schedule. If you are confident that you will sell the home or refinance before the ARM's initial fixed period ends, commonly 5 years, the ARM can be a strong choice. This is particularly compelling for people who move frequently, anticipate career relocations, or have clear refinance plans. Next, let's balance this with the security offered by the fixed-rate option. A fixed-rate mortgage removes interest rate uncertainty for the entire term. Your principal and interest payment does not change, making it easier to budget and sleep at night. Even if rates seem high today, locking a fixed rate can provide long-term stability. And if market rates decline later, you typically have the option to refinance to a lower rate without penalty, effectively securing the upside while capping the downside risk. With both sides introduced, let's move to the crucial stress test that determines whether an ARM is acceptable risk for you. To run the stress test, first identify your ARM's specific adjustment rules: the size of the initial adjustment at the end of the fixed period, the periodic adjustment cap, and the lifetime cap. Second, compute the payment you would face if the rate jumped to the lifetime cap, applied to the remaining term. Third, ask yourself whether you can carry that payment for at least a year or two without hardship. If the maximum payment would cause meaningful financial strain, you should avoid the ARM. Finally, establish exit strategies such as refinancing, selling, or making targeted principal prepayments before the rate resets. With this framework in mind, let's visualize how ARM adjustments flow over time. This flowchart shows the life of an adjustable rate mortgage. You start with the initial fixed period, for example years 0 through 5 at 3.8%. At the end of that period, the loan can adjust. If market rates are stable or lower, you may refinance into a new fixed rate or simply keep the ARM if its index plus margin is still favorable, keeping payments manageable. If rates are higher, the ARM applies its initial adjustment, for example 2%, moving to a new rate like 5.8%, with caps constraining how much the rate can change. In subsequent years, periodic caps may apply until the lifetime cap, such as 8.1%, is reached. An important optional branch is to prepay principal or sell the home around years 4 to 5, which exits the ARM path and avoids higher adjustments. Now, let's review a concrete numbers example to quantify potential savings and risks. This table illustrates approximate principal and interest payments on a $400,000 loan. During the ARM introductory period at 3.8%, the estimated payment is about $1,865. If the ARM adjusts to 5.8% at year 6, the payment could rise to roughly $2,278. In a worst-case scenario, where the lifetime cap of 8.1% is reached, the payment could increase to about $2,807. By contrast, a 30-year fixed at 4.99% would remain around $2,144 for the full term. These are illustrative calculations to demonstrate direction and magnitude. Your actual numbers will vary by lender, margin, index, caps, and remaining balance. Next, let's test your understanding with a quick quiz. Question: who is generally the best candidate for an ARM with a significantly lower initial rate, for example 3.8% versus 4.99% fixed? Options: A. A buyer planning to keep the home for over 20 years and who dislikes payment changes. B. A buyer confident they will sell or refinance within 5 years. C. A buyer who cannot afford the cap payment but hopes rates fall. D. A buyer relying solely on builder incentives to qualify. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. A buyer confident they will sell or refinance within 5 years is typically best suited for an ARM with a materially lower introductory rate. This strategy captures savings during the initial years while avoiding exposure to later adjustments. Next, let's cover builder financing considerations that often accompany new construction purchases. When using builder financing, look beyond the headline interest rate. Evaluate the full package, including lender fees and total cash needed to close. Builder incentives can be valuable, but never skip independent professional inspections, even for new construction. Construction quality issues or warranty gaps can cost more than any rate savings. Always compare the builder's preferred lender against independent lenders to understand your total cost of ownership. With that advice in mind, let's compare profiles of who should prefer an ARM versus a fixed-rate loan. On the left, an ARM fits borrowers who expect a short tenure of 5 to 7 years, have high confidence in their plan to refinance or sell before adjustments, need stronger cash flow today, and can comfortably pass the stress test at the cap payment. On the right, a fixed rate is better for buyers who plan to remain in the home for 10 to 30 years, have low tolerance for payment volatility, want budgeting certainty, and value set-it-and-forget-it stability. To further clarify timing and decisions, let's view a timeline of the ARM lifecycle. This timeline outlines the adjustable rate mortgage lifecycle. From month 0 to month 60, the loan enjoys an introductory fixed rate at 3.8% with lower payments. Around month 48, consider making principal prepayments and reviewing your market rate options. By month 54, begin shopping for a refinance if market conditions are favorable. At month 60, the adjustment window opens and the rate may increase by the initial adjustment, for example to 5.8%. Between months 61 and 120, periodic adjustments can occur within the caps. Throughout the lifetime of the loan, the rate cannot exceed the lifetime cap, such as 8.1%. Payment implications are lower during the introductory period, potentially moderate after the first adjustment, and potentially higher if the rate approaches the cap. Next, let's walk through a markdown-based stress test example with the actual math steps. Here is a markdown-style walkthrough of a stress test using approximate numbers. The loan amount is $400,000 over 30 years. The ARM has an introductory rate of 3.8% for 5 years, then could adjust to 5.8%, with a lifetime cap of 8.1%. The fixed alternative is 4.99%. The ARM's principal and interest payment is roughly $1,865 during years 1 through 5. The fixed 30-year payment is about $2,144. After 5 years, the remaining balance on the ARM is approximately $360,500. If the rate resets to 5.8% for the remaining 25 years, the payment is about $2,278. If the lifetime cap of 8.1% is reached, the payment could be around $2,807. The short-term savings during the first 5 years is approximately $279 per month versus the fixed. However, the payment could jump by roughly $413 compared to the fixed if the rate resets to around 5.8%, and by about $663 if the rate nears the cap. These figures are illustrative and will vary by index, margin, timing, and exact amortization. Now, let's include a short disclaimer to frame this as education rather than individualized advice. This content is for educational purposes only and should not be considered financial, tax, or legal advice. Mortgage products, rates, margins, caps, and eligibility vary by lender and market conditions. Always consult a licensed mortgage professional and, when appropriate, a fiduciary financial advisor to evaluate your specific situation. With that clarified, let's do one more quick quiz to reinforce the stress test concept. Question: before choosing an ARM, which step best protects you from future payment shock? Options: A. Ignore caps and assume rates will fall. B. Run a stress test at the lifetime cap payment and confirm affordability. C. Choose the lowest upfront fees regardless of rate rules. D. Depend solely on builder incentives to lower payments. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Running a stress test at the lifetime cap payment and verifying you can afford it is the best way to guard against payment shocks. If the worst-case payment is unaffordable, then the adjustable rate mortgage is not suitable. To close out, let's summarize the key points you should remember. Here are the key takeaways. First, time horizon drives the choice. Short-term occupancy generally favors an ARM, while long-term residency favors a fixed rate. Second, an ARM provides lower initial payments but comes with future rate risk, while a fixed rate offers stability and predictability. Third, always run a stress test using the lifetime cap and plan your exit strategies. Fourth, builder incentives can be useful, but independent inspections and total cost of ownership are more important. Finally, if you choose a fixed rate today, you retain the option to refinance later if rates fall. To wrap up, align your mortgage product with your planned tenure and risk tolerance. Quantify your decision using real numbers and the specific cap structure. Do not rely on headline rates alone. Use refinancing, selling, or targeted prepayments as levers to manage risk. And if uncertainty keeps you up at night, prioritize the stability of a fixed rate. Thank you for watching. If you found this helpful, please like, share, and subscribe for more actionable mortgage and money content. Tell us in the comments whether you are leaning ARM or fixed, your expected time in the home, and how you are planning your stress test. See you in the next video.